And this is kind of what happened in 2007 when the real estate market started to collapse. The Fed started printing, cutting rates. The problem was the liquidity didn't stay in the stock market and the real estate market where they wanted it. It started to leak into the commodity markets, and ultimately it drove that spike in oil up to $140. I think the same thing's going to happen here. If we get a crash in the stock market, Fed's going to panic, they're going to print, that liquidity is going to, more and more of it's going to go into the commodity markets, and we're going to get our next wave up in inflation.
I'm joined this month by Gary Savage of Smart Money Tracker. We have not had a chance to talk to Gary for some time, so I'm really looking forward to catching up with him. Gary, welcome back to the channel. We're at an interesting point at the moment. We've got stocks that have been on a tear. Is this something that's going to continue?
I think it will eventually, but I'm getting a bit nervous at the moment. Most of the moving averages are stretched quite far above their long-term mean. That's usually a warning sign. All markets regress to the mean eventually, and the further they get stretched away from the mean, either up or down, more often than not, you trigger a regression event. And the further it's stretched away from the mean, the more aggressive and violent that regression event can be. And then add on top of that, that we're moving into the timing band for a 4-year cycle low for the stock market. We're getting
talk to me about that. So the 4-year cycle low for the stock market. So just give our listeners and viewers just a little bit of background to that.
So generally, roughly, about every 4 years, you'll get one of these big corrections in the stock market. Very often it's there's some kind of a financial crisis. Of course, the last one was COVID in March of 2020. Huge move down in the stock market. Before that, it was 2016, 2012, and then that bottom in 2008, 2009. So we're 4 years out from the March 2020 bottom. So we're due for that 4-year cycle low anytime now. Markets are stretched quite far above their long-term moving averages. We're getting quite a cluster of Hindenburg omens on the NASDAQ. We're getting a bunch of Titanic syndromes on both the NASDAQ and the S&P. So
Hindenburgs and Titanics, what are we talking about there?
They're just they're a sign of a split market, a market that has a lot of, well, I wouldn't say a lot, but a bunch of new highs, but then also a bunch of new lows. And that's not a normal market. There's something wrong with that kind of a market.
Have you a chart there that you can pull up and just talk us through that, so we can see some of these things, the cycles, and then the various different new highs and lows that you're talking about there?
All right. So here's a long-term chart of the NASDAQ, and this is what I'm talking about. Here was our last 4-year cycle low. This was the COVID recession. And you can see price was getting stretched pretty far above this long-term moving average. And then you get the recession and you get the big collapse back down to the moving average. And then central banks come in and they start printing trillions of dollars of yen, of euros. And you get this huge move up, again, stretched way too far above averages. And you get a regression event back down. But this was too early for this to be a 4-year cycle low. So I suspect we're going to have another big move down, and you can see we are again stretched really far above the moving average. And now we're in the timing band for that 4-year cycle low. So I suspect here soon we're going to get, I wouldn't say a market crash, but maybe a mini crash. I think we will definitely go below this low, and almost all 4-year cycle lows will take price back to, or maybe even below, the 200-week moving average. That's what this is right here, is the 200-week moving average. So I'm going to say we've probably got a date with a test or a move maybe below this 200-week moving average sometime this year.
Wow. Okay. 'Cause that's a decent 20+% correction then, and from where we are at this stage. Is that what we're looking at, yes?
Yeah, it is. Um, Usually, when you get these 4-year cycle lows, the selling pressure kind of infects everything. So, although it depends on what causes the recession. Now, if it's an escalation in the war, which seems like the most likely trigger event to me, that may not affect oil and metals and commodities in general. It may just affect the stock market. So, but there could be some margin selling when that happens, and that's what happened to gold right here. We had margin selling in gold back in 2020, even though it was pretty brief, and then gold took off again to the upside in response or in anticipation of all the money printing that was going to come to rescue things out of this.
You've got some ambitious targets for both gold and silver over the long term. Where are they? What are you seeing at this moment in time?
We are in an intermediate correction at the moment, but I don't think it's going to play out as these previous intermediate corrections. Here's one. These were corrections where price moved down pretty sharply, and that cleared bullish sentiment, built fuel for the next rally. Same thing here. This one's playing out a little differently in that it appears that this one's going to be going sideways. So these intermediate corrections can play out in one of two ways. They can either correct and shrink the gap between the moving average and price, or they can just go sideways and allow the moving average some time to catch up. It looks to me like this one's probably going to play out as mostly a sideways churn over time. Although I think we will probably get, some kind of a move down here in the weeks ahead. But it may be March before this sideways correction is done, and then we get our breakout. But I do think 2024 is going to be the year where we finally break out above this, which is now a quadruple top, and then we get not a 2 or 3 hour breakout like we had back here in December, but a breakout that is sustained and takes gold to 23 or 2,500 before we have our next intermediate correction. Over the long term, I'm on record. I think $100 silver is going to be a piece of cake. And by a piece of cake, I don't mean that it's going to be a quick, easy move there. It could be a very difficult move there. I'm just saying it's going to get there. And I think it's going to get there during this 8-year cycle. So I don't think you're going to have to wait 20 years for gold and silver to get to these targets. I also think $5,000 gold is a piece of cake, and $10,000 gold isn't out of the question, and $250 silver isn't out of the question.
Are you looking at that? Are you making those calls just purely based on a technical analysis, or what's underpinning that?
A lot of it is technical analysis. The bigger the basing structure, the bigger the move is when you get a breakout from that base. The base in silver is, well, the last high was in 1980. So what are we, 40 some years building this base? So when silver breaks out above $50, $100, once that breakout occurs, is going to be a no-brainer. And like I said, 250's not out of the question. Kind of the same thing for gold. We've been building this base at basically at about, we tested it in 2011 at 1900. A brief little breakouts here, but we're not getting any follow through. So at some point we're gonna break out and get follow through, and that is also a pretty large base, 12, 13 years now. Once that breaks out, I think it's going to go a long ways.
These things never happen in a vacuum. So what's happening to the dollar in this scenario?
I'm going to say there's going to come a point here where gold is going to start to ignore the dollar, but I suspect the dollar has probably topped, but is also going sideways and churning before we can get another leg down, and that'll probably initiate the breakout. And then, like I said, at some point, I think gold just starts to ignore the dollar, just like for the most part, oil and stocks, they pretty much ignore the dollar, what the dollar does as well.
Does this become an inflation question, or what's the cause of gold or oil ignoring the dollar?
So a lot of it is an inflation play, and then a lot of it is also geopolitical risk, in my opinion, is what's going to drive the sustained move in gold once it breaks out above 2,100.
And maybe you pull up the silver chart for us there, and we'll just have a look. And if you could map out that pathway to $100 silver for us, that would be quite interesting.
All right, so here's a chart of silver. Here's that peak in 2011, and this basically was a double top from the 1980s. So we didn't get the breakout here. So the basing pattern is continuing. So you can see what happens to silver when it moves big and it moves quick. So it can just go for years and years and not do anything, and that's what we're having here. I mean, we've done nothing since 2011. But don't let recency bias convince you that because silver hasn't done anything, that means it's never going to do anything. You could have made the same argument here. Silver had never done anything until it did. So I suspect what's going to happen is once gold breaks out above 2,100 and we start to get a sustained move, silver is going to make a move to test this $30 level. And then at some point here, it's going to break out and it's going to go back up here and test $50. It could take 2 years for silver to test this $50 level. Then once it breaks out above 50, it could, you can see what happens here. Once the breakout occurs, it can just go crazy nuts to the upside. So once we get a breakout above 50, we could literally go to 250 over the next 8 months, or let's say we could go to $100 over the next 8 months, but then you could go to $250 over the next 6 weeks. That's just how that's how silver moves, and that's how a bubble moves. It could take a long time building the bubble, but then in the final weeks of the bubble, price can just go insane to the upside. So just because it hasn't done anything doesn't mean it's not going to. Now, silver is very volatile. It can do all kinds of crazy things. So here's the triangle that people are looking at. So I would not at all be surprised if silver breaks below this pattern, but then reverses, and then we get our move up to $30, and eventually we get the breakout, and off we go. It's a thin market, and it's can be very erratic, very volatile, and it can have some crazy moves to the getting everybody on the wrong side of the boat. Here's a perfect example. We had a breakdown below this support zone. That should mean that silver is headed much, much lower, but you can see what happened. It reversed, and then we end up getting our I wouldn't say a bubble phase. We end up getting our bubble phase and our final top of that cyclical bull market in 2011.
And you can see there from kind of 2008 to halfway through 2011, which is 3 years, it's gone up by nearly a factor of 7. So it's gone up like 700% in that 3-year period. Yeah. So it's not inconceivable what you're talking about there. We've seen it happen more than once in the silver market in the past when it's had that long basing pattern and then finally breaks out. It's a significant move higher.
You get these big quick moves in silver. You have one here, you have one here, you had one here and here. That's just the way silver moves. It kind of lags and lags and lags, and then at the end, when gold starts to get really expensive, people look for something that's a little cheaper that's following gold, and that's silver. And it doesn't take a whole lot of liquidity moving into the silver market to produce these big moves at the very tail end. So don't discount silver because it hasn't moved. It's going to.
Will you tell me a little bit more about Smart Money Tracker?
So that's my premium site. Now, if you want to view some free videos, I put some free videos on the free blog, which is blog.smartmoneytracker, or you can just Google Smart Money Tracker. The premium site, I always do a longer weekend version where I cover the three main markets that I cover are precious metals, the stock indexes, and oil. I also look at currencies, although I don't trade currencies, but currencies have some effect on the metals, so I do track the currencies. Mostly my tools are cycles and sentiment, so I trade based on those. And then I also produce daily reports, sometimes as many as 3 or 4 daily reports a day, just as things pop up on my screen. If I see something that has some attention, I think we're getting close to at least a short-term trade in the metals. I think it may be a little bit longer before we're ready to break out of that sideways consolidation in gold, but I think we could set up for a short-term trade here soon.
Finally, I want to have a look at oil because two things. When you're looking for a decent move in that back up to over $100, longer term, I'm not too sure of what your targets are, but oil is the one thing, whether people realize it or not, that from an inflation point of view has one of the biggest impacts on the money in our wallet. And quickly, when oil goes up, the price of gas or petrol this side of the water goes up and dramatically squeezes available funds and disposable income. So knowing what's going to go on in the oil market is of keen interest to a lot of people watching this channel.
So here's the chart of oil. And again, my prediction is $200 oil is going to be a piece of cake. Again, doesn't mean it's going to be an easy ride to get there, but I just think it's going to get there. I think this was the bell ringing that the bear market in commodities that began at that 2008 top when oil was $140 and the bubble popped. I think this was the bell ringing that the bear market was over. Oil went to negative, whatever it was, $35. And we started a new bull market. This was the first leg up in the bull market. And then we get our move down into the 3-year cycle low. The CRB has the multi-year cycle, and the CRB is 3 years. So the CRB and oil in general started to move down into that 3-year cycle low. It looks to me like oil is probably forming what may turn out to be a cup and handle basing pattern. Maybe we're starting to get some momentum on the right side of the cup. And then once we get up here, we'll probably have to have a long handle, basing pattern before we can get a breakout above this, call it 130, 140 area, and then a move up. But this is the big driver of inflation. Everything has an energy component. So if oil is going up, everything's becoming more expensive.
We're talking about there significant moves higher in all the commodities, specifically if you're talking about gold, 2,500 and above, and you see the potential long term. You don't think that 5,000 or 10,000 gold is out of the question. You think $100 silver will definitely be achieved, and in a blow-off scenario, you could even see something like $250 silver. Significantly higher oil prices. Again, $200 is where you're looking at there, and that's going to have significant implications for everybody, not just investors, but everybody, and it's going to hit the wallet hard and fast as well. At the same time, you think that we're due a significant 4-year cycle low in stocks as well, so we should have or could be looking at 20% correction in the Nasdaq this year.
Correct, and I think that is the underlying driver, which is going to increase inflation, because the Fed's not going to sit by and do nothing. If we get a big move down in the stock market, especially before an election, they're going to slash rates. They're going to print money, and I think right now most of that liquidity is going into the stock market. But I think that's going to change. You're going to see a lot of, if the Fed has to embark on another rate cutting cycle, which they will, and more QE, I think you're going to see more and more of that liquidity leak into the commodity markets. And so you will get a recovery in stocks, but you will also get a lot more inflation in the commodity markets. And this is kind of what happened in 2007 when the real estate market started to collapse. The Fed started printing, cutting rates. The problem was the liquidity didn't stay in the stock market and the real estate market where they wanted it. It started to leak into the commodity markets. And ultimately, it drove that spike in oil up to $140. I think the same thing's going to happen here. If we get a crash in the stock market, Fed's going to panic. They're going to print. That liquidity is going to, more and more of it's going to go into the commodity markets, and we're going to get our next wave up in inflation.
We have been warned. You've heard it here first. Gary Savage, thanks for joining us on the channel again.
Thanks, Dave.